Hello, hi, how are you guys? I hope your group 1 examinations has gone well. I heartily welcome all of you to this one day before the examination marathon revision for CA Intermediate Advanced Accounting paper 5 of your intermediate syllabus. So, considering the fact that your examination is tomorrow and we have one day left, and we are here to discuss the group 2 accounts to ensure that you are going to do this paper really very nice. Yeah. So it's going to be a 4-part revision. Sessions are going to go for 4 videos of 1 hour each, about 4 hours, and I promise you revision of all the concepts of the most practical paper of your CA intermediate. You can question me, why am I calling this the most practical paper? What basis do I have to call this? This is completely based on the information given in BOS knowledge portal, Board of Studies, which clearly mentions each paper of intermediate में what is going to be tested. If you focus on the paper of accounting, comprehension and knowledge, what is mugging up and then writing, literally the same question coming up, is to the extent of 5 to 15, and based on analysis and the application of the knowledge that you carry is to the extent of 85-95, and the same holds good with the advanced accounting 85-95. No other paper comes up to this levels of 85-95 paper, so I can very proudly say, so this is going to be the most practical paper of your CA intermediate syllabus. So this is our index, what we're going to discuss through, and accounting units will not be covered in this session. So we're going to start with the second chapter in the module 2 and do module 2 and module 3 completely. I mentioned it wrong. We'll not be doing chapter 2 at first. We'll be starting with module 2 at first. That is with employee stock option plan, buyback and equity shares with differential rights, amalgamation, internal reconstruction, liquidation, and then we'll go about banking companies, non-banking financial companies, and consolidation, and also do partnership. So all of this together we're going to cover in 4 hours. So how are we going to cover in 4 hours? Obviously we'll not be doing any problem. As I stressed here, advanced accounting and accounting are a papers where no much stress is on comprehension and knowledge. It's going to be more on analysis and application. So we're going to stress on concepts. We're going to understand what is to be done, what is expected, and what are the concepts that we should be very clear with. And this is the best last minute revision that one can get before they do problem on each type and get into the examination hall and then rock it between 2 to 5 tomorrow. Yeah. So without wasting much time, let's get started. But before we do that, I have a small announcement for all of you people. This is with regard to the flagship model of Unacademy, that is CA Iconic program. Unacademy's Plus platform was nice. Unacademy's Iconic program will be amazing. It comes with added benefits of hard copy of the material coming to your doorstep, evaluation of test series that you take up, one-to-one mentoring, one-to-one doubt solving, and you also get to be part of Nord discussion channel for all your doubts. Yeah. So what are you waiting for? Take up Unacademy subscription today, and then you get to be part of one-to-one live program, mentorship program, which gives you all these benefits over and above the Plus subscription. And as I mentioned to you, evaluated test series as well. Iconic subscription for CA intermediate, a 6-month subscription comes at the cost of 30,000, which is 5,000 per month. A 12-month subscription comes at 38,250, which is 3,188 per month. And a 24-month subscription comes at 62,000 rupees, which is 2,583 per month. And if you use the code YESHAS, which is YESHASLIVE, YESHAS Live, you get 10% off on the price that you just saw on the screen. So what are you waiting for? Take up your Unacademy Iconic subscription today and join us in our learning. And I really hope that you guys wouldn't need it and you clear it this very go. Please recommend your friends to join and take up Unacademy subscription. And a link to the entire thing is available in the description to this video. So that's with regard to the batch announcement. And now let's get back to the syllabus. We are here with CA Intermediate Advanced Accounting Quick Revision the day before examination marathon. We'll now be starting with the first chapter from module 2, technically the chapter 3 of your syllabus, that is accounting for employee stock option plans. Yeah, and then we'll go to buyback, equity share with differential rights, amalgamation. It's going to be 4-part video of 1 hour each, which will sum up all the concepts that you require to learn for advanced accounting paper other than the topic of accounting standards. Yeah, chalo, let's get started. To start with, let's go to employee stock option plans. What exactly do you guys mean by employee stock option plan? For the hardworking employee who gives not just his heart and soul but kidney and brain also to the company is trying to give him the shares at a throwaway price. Why does the company do this? Company does this to ensure that the employee will feel like he owns the company and he's also part of the ownership. Yeah, so here is with regard to the weightage of the entire examination. 33 to 38% of the marks is expected from ESOP, buyback, differential rights, amalgamation, internal reconstruction, and liquidation together. From the chapter of buyback, you can expect maximum of 10 marks and a minimum of 5 marks. I've also mentioned to you as to what are the marks that's been asked in the examination so far conducted by ICAI. You can look into this as you pass and then look at it. Now let's go into the topic. Here is some news with regard to ESOP. ESOP has changed the fortunes of a lot of people. It has made a lot of people millionaires from being just after all employees of the company, because once their shares got vested, they sold it in the market or the company got acquired by a bigger one, like that happened with Flipkart and Walmart, and all the employees sold their shares to Walmart and then made huge amount of money. Yeah, and same happened at Infosys also. Drivers became millionaires, electricians became millionaires. All that's possible with this powerful tool called employee stock option plan. So to understand what exactly is employee stock option plan, we'll go into this diagram. This material also will be shared to you. You just have to ping me. Yeah, I am CA Rajavardhan, or you can find me by the name Accounts Man. Yeah, find me on Telegram, text to me, and then I'll definitely share this file with you people on the official HS Academy's Telegram channel. Yeah, it's already there on the official HS Academy and Academy Telegram channel. If you go in there and search with the files, you'll get it. If not, ping me and I'll share the file across with you people. So these people, well suited, well dressed, standing up here, are employees of the company. These employees have given their hard earned sweat to the company. Seeing this sweat as a consideration, company will give away the share. The company will give away share at lower price. Lower price means, is it lower than nominal value? No, 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 no. Lower price than the price will be lower than the market value, not lower than the nominal value. For example, this happened with regard to the recent one, Vijay Shankar, what's his name? Vijay, I don't remember, recall the entire name correctly. It's this with regard to Paytm. Paytm, each share was issued to the CEO and a lot of other employees of the company at a throwaway price of 9 rupees just before IPO. IPO mein share was listed at 2150. You all know that. Don't ask me about what happened after that. Yeah, so Paytm Mall ka to recently 20,000 crores to it came down to 100 crores valuation because the Alibaba investor of Paytm exited about 40% of the stake in the company. Fine, let's keep the current affairs aside. Let's discuss the subject, keeping the exam tomorrow in focus. In a regular class, we usually discuss a lot of current affairs and a lot of things running around this particular topic to ensure that we'll get the most practical touch possible on the topic. Yeah, so it is employee who gives sweat to the company, against which the company will give the share to the employees less at a price lesser than the market value at a future date. It is not today, they'll give it at a future date. This is to ensure that the employees stay in the company. They say if you work with the company for 3 years, you'll get these many shares. You will not get these many shares, you will get a right to buy these many shares. You would have to pay a very nominal amount, very nominal amount. And this price will be nominal value or greater than nominal value, but it will be way lesser than the market price. You get this? So this is a double-edged sword which gives great advantage to the company. Number one advantage, retaining the employee in the company. Advantage number two, now if a share of 2150 is issued for 9 rupees by the company, the differential price between 2150 and 9 can be treated as expense for retaining the employee compensation expense. And this expense can be charged against our income in the P&L, which will decrease our taxable income. So employee kush, employer kush, government also kush. So government gave this tax benefit. Why does the government give this benefit? Because it leads to upliftment of the middle class families, or let us say people who are in employee class. They'll make them get into the capitalization sector. It will motivate the people to invest the money in the capital sector. So employee kush, employer kush, management kush, and government also kush. Everyone's happy. We are also happy. Why? We can get one easy chapter from which 5 to 10 marks can be questioned in the exam, and we'll answer it, ace it, and then get into articleship and also move on to CA fine. Yeah, fine. Let's go forward. So in this topic, what is it that you're still thinking? Are you still thinking like sir didn't tell any text about what is ESOP? Yeah, it is a plan. What is ESOP? ESOP is a plan wherein the company grants the employee stock options. What did I tell? It is option, okay? It is not an obligation to buy. It's an option given. If you want, you buy. If you don't want to buy, don't buy. Whose father what goes? Nobody is crying here. Nobody is begging you to buy. It's not an obligation. It is an option given to you. Like this video. You want to watch, you watch. You don't want to watch, don't watch. But I know you people will watch. Yeah. And you'll also press the like button, subscribe button, and also put in the comments as to how beneficial was this session for your examination. Before you break your screens for me promoting this video, let's go further ahead. Yeah. By way of a contract. What is a contract? In this contract, the company will tell or request the employee to stay in the company for 3 years. They'll tell, if you stay in the company for 3 years, you will be eligible for these many options which you can buy, and once you buy, you can sell in the market and then make money. Get that? So it is based on the period of employment. If the employee fails to stay with the company for that period that is so agreed, employee will not be eligible to take up these options. I hope you got this point. Yeah, as I mentioned, it gives right to the employee but not keep him obligated. What is it? These people know, very well dressed people standing here are all employees. It gives the employees right, but it doesn't obligate them to buy. Yeah, and this is for a specific period of time to purchase what? Oh, shares of the company at a fixed price. The price will be fixed on the date of grant only. Yeah, and this is generally lower than the prevailing market price, not the nominal value. It will be more than nominal value for sure, but it will be way less than the market price. If you want, actually, just a random fact, not to be required here, the company can issue the share way below nominal value also. That is a discount. Why? Section 53 prohibits issue of shares at discount, but it says notwithstanding anything given in Section 54 of Companies Act 2013. Section 54 tells that we can issue shares at discount if it is sweat equity shares or employee stock option plans. I hope you guys understood that part. Come on, let's get going. So with regard to employee stock option plan, there are certain important dates that we need to know. Number one is GD. Sir, what is GD, sir? GD is what is a group discussion. Huh? Hey, when you are studying the day before the examination, you should already be knowing this. GD by here I mean grant date. The date on which that agreement is signed between the employer and employee, wherein the employer will say, hey employee, if you work with me for 1 year, I'll give you 100 shares. That contract they enter, no, that is the grant date. Now when the employer asks the employee, you work with me for 1 year, that 1 year is vesting period, contract period. This is the contract period for which the employee should be associated with the employer to be eligible to get this employee stock option. Once he is eligible, it is optional with him. If he wants, he can take or not. At the end of the vesting period starts this period called exercise period. What is exercise period? Exercise period is the period during which employee will exercise his option. Means what? Buy the shares of the company. Exercise period. Period when employee can. Such period where employee buys the shares is called as exercise period, or you can say exercises option. Yeah, and then this is the date. What is the date? Exercise date. That is the exact date on which he bought the shares. Exercise date is the exact date on which he bought the shares of the company. So these are the important dates. We are going to learn what entry to pass on this date, what entry to pass during the vesting period, and if accounting period ends during vesting period, meaning if the vesting period stretches over more than one accounting period, if there are 2 years of vesting period, 3 years of vesting period, how to do accounting entries during that time, and what entry to do at the time of exercise date, and what to do if the shares are not exercised by the employee, and what entry to do if the shares are exercised by the employee. We're going to learn both the points in this particular session. Hello. Let me take you further ahead. Yeah, what do you mean by grant? As I just mentioned, grant means issue of options to the employee under ESOP. Grant date is the date on which option is issued, that is entering into contract. Vesting period for which the employee has to be in the company. Vesting period during which vesting of the option is granted or it takes place. Exercise, the date on which or the period during which the employee will exercise his option or convert his option into share. And then we lastly have exercise price. Exercise price, the price that the employee should pay to get the share of the company. What is it? It is a price that the employee should pay to get the share of the company. See this? Purchase price payable by the employee. Market price is the price that is there in the market. Yeah. In the case of our Paytm, what I told, 9 rupees was the excise price, 2100 or something was the market price of the share, valuation game. Yeah, so the differential between these two is there, no, about the 2000 rupees and 9 rupees, 1900 odd, whatever, that money is intrinsic value of the option. What is it? It is the intrinsic value of the option, that is excess of market price of the share under ESOS over the exercise price of the option, the money that you didn't collect from the shareholder, which will be the expense to you, is that intrinsic value. This much money is considered as the expense and it should be booked over the period. You get this? And there's a part of computation of fair value using Scholes model or binomial model, which is part of CA Inter Financial Management. You'll also be reading this in CA Final Strategic Financial Management. However, it's not part of sorry, you won't read it in CA Inter. You'll read it in CA Final Strategic Financial Management SFM paper. So you don't have it anywhere here. Yep, I hope you guys got this through, and let's quickly see the accounting entries as to what accounting entries are to be passed. On the date of grant, when the options are granted, the company passes no entry. See, no entry. Salman Khan, Anil Kapoor, Bipasha Basu, Tara Datta, all of them are there. Yeah, no entry. You don't have to pass any entry. I know it's a little funny. That's what I intend to. I'm lightening the mood, considering the fact that you are having a little exam stress, keeping in mind your tomorrow's examination. Yeah. Okay, so on the date when the options are granted, the employer doesn't pass any entry. Why? It is just a contract being signed. There is no literal transaction happening. However, during the vesting period, at the end of each year, entry has to be passed by the employer. What sort of an entry? For instance, a share which is having a market price of rupees 1000 is issued by the company to the employee at an excise price of say 100,000 rupees market price, 100 rupees excise price. Difference of 900 as a company you are not collecting. Such difference of 900 rupees is your intrinsic value. That is expense. This expense is something that you are incurring to retain the employee in the company for maybe 3 years. So for retaining the employee for 3 years, you are incurring 900 rupees expense, meaning you're giving discount of 900 rupees on shares. That 300 rupees what you give it to him as discount, it has to be booked as expense over the 3 years period. It is not expense of one single year. First year may 100, second year may 100, third year may 100. So we have to write this entry wherein we book expense. So employee compensation expense account debit to employee stock option outstanding account, because we are not giving them shares right now, we'll give it later. Till then it's a liability. So this credit, my friends, here is a liability. At the end of 3 years we'll give him share, then this liability will be closed, but as of now it is expense. So expense debit, liability credit. And what do you do with this employee stock option outstanding? It will remain as liability in the balance sheet till the maturity date or till the date of excising. However, this employee compensation expense, whatever you have written here, this gets transferred to P&L because it is your expense. Like I mentioned, employee compensation expense will move to P&L, whereas employee stock options outstanding, whatever is there, no, that would remain as a liability in the balance sheet till the excise period lapses. Got this? This entry, whatever we saw now, this has to be passed at the end of each year, not just at the end of 1 year, at the end of each year throughout the vesting period. Now, at the end of vesting period starts the excise period. In the excise period, on the excise date, if the options are excised, meaning we provided for 900 discount, 300, 300, 300 every year. 3 years are over, now the employee is buying the share. Exercising his option. How does he exercise his option? He buys the share by paying 100 rupees. So 100 rupees is received from him. I will write 100 bank account debit, 100 rupees received. 900 rupees, we would be writing it to employee stock option outstanding. Sir, what is this? This is a liability which we had previously created. Yeah, if you guys observe, every year we wrote no employee compensation expense to employee stock option outstanding. 300, this entry was written 3 times. When you write that 300 every year in our example, when you write 300 per year every year, total amount will come to 900. 900 rupees are there, so such 900 will be used here. Such 900 ka liability will be closed, and then you write them shares. Maybe share is of value 10. That 990 rupees what you collected extra is security premium, that you transfer to security premium. Usually shares will be of 10 rupees or 1 rupee only. Entire money that's collected will be, major part of the money will be towards security premium. To transfer so much money to security premium. Now after the excise period, if any options are lapsed, meaning you created employee stock option for some 50 employees, Say 45 employees stayed in the company and are availing this option. 5 of them, they're like, they left the company and they went. So you had previously debited the expense, created the liability. So much liability is not there on you now. You don't have to give shares to them at discount. Why? They're disqualified. They left the company. So what do you do with that expense? That expense has to be reversed now. But we can't reverse that expense in the current year. You can't write reversal of this entry what is here. You can't write employee stock option outstanding to employee compensation expense. Why? Because if you reverse this expense, it will lead to profit. It will lead to booking of complete profit in the current year. Current year profit will shoot up because you booked some expense in the last year, which is actually not expense. Now, which was wrongly booked in the last year, I agree, but recording it as income in the current year is not right. So it cannot be current year income. What do we do? And you can't adjust it to the previous year's income. Why? Previous year's books are already closed. So what do you do? So only thing that you do is you transfer such money to capital reserve or general reserve. What do you transfer it? Where do you transfer it to? From employee stock option outstanding account, you transfer such money to general reserve. General reserve is a reserve increasing, so we credit it. Employee stock option outstanding is a liability which is no longer exists. Liability decreasing, so we debit it. So my friends, the entry is employee stock option outstanding account debit to general reserve account. Done? Great. So this is one important point that we need to know. Employee stock option outstanding is being a provision made. It has to be decreased when the option lapses. Every year, whenever the option lapses, maybe 3 years is the period, no? First year there are 50 employees. Second year may say there are 40 employees. So what should you do? First year you had created provision for 50. Second year you need to create provision for 40. In the second period, you don't create provision for 40 straight away. You understand as to if it was 40 employees in first year, 40 employees in the second year, how much is the total provision that should have been created at the end of second year? You determine that. From this, you deduct the existing provision already created in the first year for 50 employees. Balance provision will be created in the current year. Did you get this? Let me repeat. First year may you created provision for 50 employees, out of which 10 employees left. In the second period, there are only 40 employees. You have to create provision for 40 employees. First year, it's already done. Provision created, debited to PL. In the second year, when you have to create provision, what you do is, you will assume that there are only 40 employees in first year, 40 employees in second year. These people are eligible. For these 40 employees, how much of provision is to be created at the end of second year? You compute this. Once you compute this amount of provision, from this provision amount, what is to be created for 40 employees over 2 years, you deduct the provision already created in the first year for 50 employees. The balance of the provision will be created in the second year. You get this? So that's something that you need to keep in mind. Same thing I've given across in red and in terms of a beautiful sentence. Read this. Employee stock options outstanding being a provision made, it has to be decreased when option slabs after expense has been recorded against them in previous years. In such a case, adjust expense and create lesser provision in the remaining vesting period. Very good. If provision is still in excess, then it has to be reversed. How do we reverse it? How do we reverse it, guys? We will reverse it by transferring to general reserve. By transfer to general reserve. Really hope that you guys understood whatever was just discussed. Come on. Let's quickly see how do we compute such amount of expense. Amount of expense should be computed like this. You take the outstanding expense amount, outstanding options, meaning total employees less the number of employees you have left. If you take the total employees less the number of employees you have left, you will get number of employees working. That you multiply with number of options eligible for each employee. So number of employees eligible multiplied by options for each employee. When you multiply, you get options outstanding in total. For this, you need to multiply with intrinsic value. How do we get intrinsic value or employee compensation expense? It is the current market price minus the excise price. That is a differential amount for which we need to treat it as expense. Yeah, this you multiply by the current year. Maybe if it is the first year 1, if it is the second year 2, if it is the third year 3, divided by the total vesting period. In the first year you do 1 by 3, in the second year you do 2 by 3, in the third year you do 3 by 3. That will tell you how much provision should be maintained at the end of that year, so that you will have enough money to do exercising the options at the end of the vesting period. Yeah, From this, you deduct the cumulative expense which is already created till date. And when you do that, you, my friend, will get to know as to how much provision needs to be created in the current period. I hope you guys understood. And this is how we do. And that is the end I can say with regard to employee stock option plan. And we will now be moving on to the next topic. There's little bit of theory that's there with which we should know for the examination perspective. That is with regard to section 62 subsection 1 clause B, which talks about employee stock option plan, how to go for it. You need to have a special resolution, and then the company should have functioned for minimum 1 year. Sorry, option time gap between one and the other should be minimum of 1 year. And then there's this intrinsic value method, fair value method, and stock based plans, ESOP, ESPP, stock appreciation right. All of this theory, how is it, what do you mean by cash settled, what do you mean by equity settled, all these are there. These are not very crucial parts, and you cannot expect questions on this topic in the examination. So I'm skipping this part considering the fact that this is marathon revision just the day before exam. However, when you download this PDF, this entire data will be there with you all. You can definitely read through this if you want. And there's also one small topic on which a short note question can come in your exam. That is about reload feature, reload option, and why does company issue ESOP. Yeah, please do read through these parts so that you are good with regard to examination preparation, and just glance it through. You don't have to read it in detail, just quick revision, and then you'll be good. And that, my friends, is the topic of employee stock option plan. And now I'll take you all to the next topic. That is, we'll just stick it up in the index, makes us feel good now that we're done. So the first video of this marathon, we have, I'll use green, better feel. We have completed chapter 3, which is accounting for employee stock option plans. Now I'll be starting with chapter 4, which is buyback of shares, buyback of securities and equity shares with differential rights. Hello, let's get started. That is from page 66 to 87. Yes, we're now starting with the chapter of buyback of securities and equity shares with differential rights. Weightage of this chapter along with the chapter of ESOP, amalgamation, internal reconstruction and liquidation is 33 to 38% of the marks. Minimum you can expect 5 marks from this chapter and a maximum of 15 marks. Here in force I've given as to what question has come, which question on the examination paper was for how many marks from this chapter. And I've also given what topic should you be must revising the day before examination. You can read through this when you download the PDF. And now some news that we usually discuss in the regular class. We can skip all of this. Infosys went for biggest buyback ever. Yeah, so this is how the buyback works. Made this material during the COVID, so I put the people with masks so that it will be more realistic. Okay, what exactly do you mean when you say buyback? Yeah, buyback is something which is opposite of issue of shares. In the case of issue of shares, people give money. See this? All of these people here, people, they give money to the company and company gives share to the people who gave the money. You get this? However, buyback works other way around. It is ulta. What's the other way around? Company will give the money to the shareholders and shareholders will give the share back to company. So it's an ulta case. The company is going to buy the share back from the shareholders. That, my friends, is buyback of equity shares. So why does the company do this? Why does the company do this? So there are a lot of reasons why the company would go for this. Okay, to increase the earnings per share. See, in order to increase the earnings per share, you know, right? You might have done this in financial management. ETH, or earnings available to equity shareholders divided by number of shares, is what we do. Either we need to increase the profit or decrease the number of shares. Either increase the numerator or decrease the denominator. That's the way in which you can boost your earnings per share. The next thing is to avoid hostile takeover. You might have heard of this, something called poison pill, yeah, slow pill, what Twitter tried to do when Elon Musk was starting to acquire the shares of Twitter. So that's something like this what we can do, as we all see in the filmy way. When someone is trying to acquire major stake in your company to have control, then company as yourself can start buying the shares from public, so that you ensure that hostile person who's trying to take over your company from outside will not have the substantial stake in the company. That's another reason. Or to increase the promoter's holding. Certain times, if you have to take some big decisions, if you go for voting and then go to pass special resolution, public might not favor so much risk and then give consent to such decisions. So if you want to go for some major earth-breaking changes in the company, or you want to pass some harsh resolutions, and people are not okay with that, then directors would have to assume that risk. So they would have to buy the shares back from the public. They hold the stake with them. They take the risk, vote for it, and if it succeeds, then they can dilute their shares by again going for issue at a later stage. Yeah, but that's one other reason why the company will go for buyback. Another thing is to support the falling market price. The market price of a share is falling continuously, and the company thinks this price is not the right value of my company. My company is should be valued way ahead of this. Then what the company does is they will ensure that they offer a buyback, and once the buyback offer is made, the market price will almost try to come close to the buyback price offered. That's how they support the falling market prices, or letting the shareholders realize their gains, because company doesn't see any great project of investing that money in, so the company goes for it. Or you can say company has too much of sufficient cash and then they're going for it. Yeah, buyback of shares means what? Purchase of its own shares by the company. Yeah, shares bought back have to be cancelled. Company cannot reissue them. Okay, leading to decrease in share capital of the company. Buyback cannot be for the purpose of investment. Company cannot invest money in itself. Yeah, this should be with an other objective. It cannot be investing objective, and this is possible only when the company has sufficient cash. Got it? So I hope you guys understood the basic topic of buyback. Let me now go into section 67. Section 67 of Companies Act 2013 says that a company cannot buy back its own shares. No company is allowed. Other than this chapter is involved. Read section 67 completely. It says, however, there are following exceptions. What are the exceptions? Number one, redemption of preference shares is allowed under section 55. Number two, reduction of capital is allowed under section 66. This is the internal reconstruction chapter. And then 68 of Companies Act says that buyback is allowed. However, section 68 places a lot of conditions. What are the conditions that 68 places? It's like a wedding. If you are going for a wedding, or if you are getting married, sometime before the wedding, what will you do? You start applying sunscreen, stay at home because you don't want to get tan, because it's your wedding after all, no? Yeah, you start doing that. So whenever you're applying sunscreen, you ensure that such sunscreen will protect you from all the damage that the sun is going to cause, or UV rays is going to cause, because you check at the SPF levels. Heard of this? Yes. So SPF is one thing that you need to remember, because the source comes from here. So whenever your company is going for buyback, the source of funds can be SPF. It is share capital, or it can be, what do you say, out of the premium or out of free reserves. That's what it means. Come on, quickly let's see. Yeah, sources of the funds can be only three. What are the three sources of funds for the purpose of buyback? It can be security premium, or it can be proceeds from what do you say, fresh issue of securities, or retail premium. Sorry, it is security premium, fresh issue, and free reserves. These are the three places from which the money can be pulled in for buyback of shares. Okay. Whenever you go for buyback, you need to take consent from, whenever you go for like bringing a BB home. Yeah. Whenever you go for a wedding, you need to have that, take the consent of the entire family. Take the consent of the entire family. So you need to pass a resolution, and there should be power in articles of association, and you need to pass a resolution. You need to take consent of all the shareholders. Then the next thing comes is like, it cannot be child marriage. Marriage cannot be child marriage. No, it's illegal. Similarly, you cannot buy back a partly paid up share. What is this symbolizing? No buyback for yeah. In order to buy back a share, the share has to be fully paid up. It cannot be a share of rupees 10, 4 rupees paid up. It should be a share of rupees 10, 10 rupees fully paid up. Only then the company can go for buyback. And the last thing is resolution. What resolution needs to be passed? If the buyback that you're going to do is up to 10%, if the buyback that you're going to do is up to 10%, then board resolution is sufficient. Whenever the company is going for 25%, then you need special resolution. Oh, sorry. I mean to say, here ordinary resolution is sufficient. However, when the company is buying back 25%, then you need to go for special resolution. Then, before going to take such a major decision, you need to review the decision that you're taking. What should you be doing? Review the decision. You need to review the decision. In order to review the decision, you need to take DRS. DRS means Dhoni review system? No, decision review system. Whatever. You need to do three tests. Three tests. What are three tests? Test number one, D. This, my friends, is debt equity test. Then comes R. This is resource test. And then last one is S. Share outstanding test. These three tests have to be done only on successful completion or successful fulfillment of all the terms given in these three tests. That when the company can go for buyback of its equity shares. So buyback may three important points you need to remember. Number one, source of funds. Okay, remember a wedding. So you apply sun cream. SPF. Only these three sources से money can come. Number one, S, security premium. P, proceeds of fresh issue. F, free reserves. Second point. So if the wedding is happening, there should be consent from all the family members. So you should have power in articles of association. You should also pass a resolution. And next thing, no child marriage, meaning a partly paid up share cannot be bought back. In order to buy back, the share should be fully paid up. Third part is resolution. If it is up to 10% buyback, ordinary resolution will do. If it is 25%, 10 to 25%, then you would have to go for special resolution. And finally, you need to take the decision review. So in order to take the review of the decision, you do three tests: debt equity test, resource test, share outstanding test. Once all these three tests are fulfilled, only then you can go for buyback. Got this, guys? So let's see all of this quickly. Sources of funds. Yeah, buyback. Section 68, subsection 1. It says the money can come from security premium, proceeds of fresh issue, as well as free reserves. Next, conditions. What conditions? Like I mentioned, it should be authorized by articles of association of the company. Shares should be fully paid up, no child marriage allowed. Resolution. If it is up to 10%, board resolution is sufficient. Oh, sorry. I was right in the first place. I'm sorry. Board resolution is sufficient. If not, you should go for special resolution. If it is 10 to 25%. So how about more than 25? More than 25% buyback is not allowed. Yeah. Then buyback is permissible only on fulfillment of three conditions. What are the three conditions? Number one, debt ratios test. Number two, resource test. Number three, share outstanding test. Debt ratio test says that after you do buyback, your equity will drop, no, because you bought back shares. That decreased equity should be at least half of the debt. It cannot be less than half of the debt. Should be half of the debt at least. It cannot be more than less. So after the buyback, debt equity ratio should be minimum 2:1. That's another way of seeing it. I'll tell you two ways of saying it. Number one, the minimum equity should be at least half of the debt after buyback. Or the other perspective of seeing this is debt equity ratio after buyback should be minimum 1:2. Oh, sorry, 2:1. 2:1. Debt can be only 2 times the equity, not more than that. So that's with regard to this. And the debt, whatever you quote here, no, the debt, it is different from the debt that you use in financial management. You do debt equity ratio there also, but the objective is different, context is different, formula is different. Here debt will include both secured and unsecured, and equity includes paid up capital, free reserves plus security premium. The second test is resource test. When you do buyback, you'd have to pay money, no, obviously. The money that you pay for buyback, should be lesser than or equal to 25% of the paid up capital plus reserves. Paid up capital of the company plus reserves of the company, add it up, do into 25%. This money what you get, no, this should be greater than or equal to number of shares bought back multiplied by buyback price. Number of shares that the company is offering to buy back multiplied by buyback price. When you do, whatever money you get, The total amount that the company would have to pay. It should be lesser than or equal to what? It should be lesser than or equal to 25% of paid up capital plus free reserves. I hope you all understood. And the last test that we have is share outstanding test. After you buy back the shares that are still there should be minimum 25%, or should be 75%, meaning out of the total shares that are there, max to max buyback possible is 25%. If a company has 1000 shares, yeah, maximum buyback in one go possible is 25%. That is 250 shares. It can't buy back more than that. Lesser than that is permitted, but you cannot buy back more than that. You guys get this? So maximum shares that can be bought back is 25% of the total shares outstanding. So all of these conditions needs to be fulfilled, not just one. Yeah, and then there should be minimum 1 year gap from the last buyback. Minimum 1 year. You can't do 2 buybacks in a single year. Not possible. So these are the conditions. Once you fulfill this, you would be able to do buyback. Now the same thing I have given in the form of sections. If you didn't like the chart approach, or if you didn't like this this image wala approach, then you can always learn it using the section 68 subsection 1 says that sources of funds will be security premium, proceeds from fresh issue or free reserves. Then 68 subsection 2 tells the buyback it should be board resolution if it is up to 10%, special resolution if it is 10 to 25, and shares should be fully paid up, no child marriage allowed, time gap should be minimum 1 year. All this is part of section 68 subsection 2. You can read this through. I'll share the PDF with you all, and I hope you guys understood. And this is a very important part. I want you all to remember this. Section 68 subsection 1. This is creation of capital reserve. We create capital reserve in a circumstance other than this also. That is when you go for redemption of preference shares. Because any reduction in the capital should be only as per internal reconstruction. No reduction of capital is justified other than by way of internal reconstruction. So whenever a company does buyback, number of shares, amount of capital will reduce. To compensate to that, the company would have to do what? Creation of CRR. CRR is capital redemption reserve, which is created to ensure that there is no decrease in the capital. CRR, whenever it is done, it is taken from free reserves and then put across to another reserve called CRR. CRR can be used only for the purpose of bonus issue. And later when the company does bonus issue, capital will get reinstated to the same original position. Got it? CRR is not a distributable profit. Remember that. CRR is created when there is redemption of preference shares or buyback of equity shares which are leading to decrease in the value of shares. In other way, whenever the company does buyback and it has issued another set of shares, so capital is come back to normal, then they won't have to create CRR. CRR has to be created only when the company does buyback of equity shares or redemption of preference shares out of its reserves or accumulated profits, or any way other than by way of fresh issue. Got that? Fantastic. And CRR is created from free reserves. Let's quickly see the accounting. I've just discussed what is CRR. It is non-distributable. I told you, no, it is not distributable as dividend, yeah, which are transferred from the redemption or purchase of company shares. Very good. Where it will appear in the liability side of the balance sheet. Fantastic. When a company redeem preference shares, that is the first place. The second circumstance is when there is buyback. Very good. Then why? First, capital redemption reserve is to protect the company's interest, creditors. Because when the money is there, if all the shareholders take the money and then run away, then what will the creditors do later? Oh, shouldn't be that way. So some other new shareholders will come in. Yeah. This protection comes from the fact that there is enough capital available to cover the creditors at the time of winding up. Very good. How do we create it? I told you, we create it out of free reserves. Reserve fund. So what are the accounting entries? Number one, you first reduce the share capital account, yeah, and then write the money to shares bought back, the shares that you bought back. Journal entries, share capital account debit to shares bought back. If in case the buyback price what you offered is greater than the share capital's nominal value, then such differential amount will be returned to premium on buyback. This premium on buyback is later adjusted against free reserves or security premiums. Here, premium on buyback, what is shifted from here's debit to here credit will be either written off against security premium. However, if security premium is not available, then we can write it off against the free reserve. And this shares bought back, whatever is there, to that extent we would have to pay money, guys. So I'll write share bought back account debit to bank account. This is denoting the decrease in the capital. and here so much money is adjusted against reserves and free reserves, security premium and free reserves, and this shares bought back account is closed by settling it in cash paid and then settle. And finally we create CRR. In order to create CRR, we'll write free reserve account debit to capital redemption reserve account. Let me repeat, the entry is free reserve account debit to capital redemption reserve account. Free reserves are decreasing, general reserve, P&L account. What is increasing? Capital redemption reserve will be increasing. Got it, guys? I hope you all understood what I was discussing in here. And this is very interesting part. This one part what people actually find very difficult and people find tricky. People don't understand how to compute this. And recently also a student walked to me with his answer script of last attempt's ka paper, and they had got this question wrong. In the recently concluded November 2022 examination, there was a question on this, meaning they would not tell how many shares are being bought back and ask you to write accounting entry. Instead, what they do is they will give the extract of balance sheet to you, and the question will ask you to compute what is the maximum permissible buyback. What is it? They'll tell you what is the maximum permissible buyback, how many shares can be bought back at the maximum extent. So when they tell that, we need to compute how much of the shares are allowed to be bought back under debt equity ratio compliance question, how many shares are allowed to be bought back under resource test, how much shares under share outstanding test. Yeah, in here it is very easy with regard to our resource test and with regard to our share outstanding test. I'll teach one at a time. Debt equity ratio test is the most critical part. I will come back to that, but first let's do resource test. What does the resource test say? It says that the amount which is utilized for the purpose of buyback cannot exceed 25% of paid up capital plus free reserves. So what do? We'll take paid up capital, we'll add free reserves, we'll add security premium. This sum of money we'll do into 25%. So this is the maximum amount that can be used. We'll divide this by the price that we pay for buying back each share. When you divide 25% of equity share capital, I'm going to say paid up share capital plus free reserves plus security premium and multiplied by 25%, what we get is the total money that can be used for buyback. Divide this by the buyback price, we'll get maximum permissible shares which can be bought back. So this is one of the condition. Then we'll go to share outstanding test. Share outstanding test says that maximum number of shares that can be bought back is 25% of the total shares outstanding. So what do? We'll see total shares outstanding multiplied by 25%. Whatever number we get, that's the number. So we take these two. We cannot take one of these. We should take both of these into consideration. Whichever is least among this will be taken. Then comes the mummy, the most interesting part. If you don't find this interesting, then I don't know what else will you find interesting. Or be very cautious, because this is something that people can mess up. This is one thing that I want you to take a note right now. Pause the video the way you're watching it and then take a note of this. This is the easiest way by far with which you can fulfill this debt equity ratio. I've seen ICI material, people do simultaneous linear equation, because debt equity ratio tells that the maximum number of shares that can be bought back is such that after the buyback the debt equity ratio is 2:1. So what do? You compute debt, you compute equity. Equity may you will write if this much is 2:1 if it is the condition. After buyback how much of equity should be there. You go with all of this computation by taking x, y and all. It is going to be very complicated, guys. Why do you want to bring in maths here? Very simple. Do this. Khatam ho jayega. Put this fraction, you'll get it. Take PUC plus free reserves plus security premium. From this you deduct 50% of the debt, because that is the amount that should be maintained. Divide this by buyback price of the share plus the nominal value. Now here comes the interesting part. You can ask me, sir, why are you adding back the nominal value part? Because this is for creation of CRR, capital redemption reserve. This is something that people usually miss out on. Why? Whenever you buy back shares, you create CRR, isn't it? When you create CRR, free reserves will decrease, my friend. And here in PUC plus free reserve formula, free reserves will decrease because of CRR. So that's a complication that people usually get confused with when they do equation. Don't do this. Always do this whenever they ask maximum permissible buyback. PUC plus free reserves plus security premium minus 50% of debt divided by buyback price plus nominal value. Do this, you will get one number. So debt equity ratio, you will get one number. resource test me will get one number, share outstanding test me will get one number. Out of all the three conditions, you see whichever is the least amount of shares, that will be the number of shares that will be eligible to be bought back. However, it should fulfill one more condition, that we should have so much cash. Check with the comparable cash available. You see cash available divided by buyback price. If you have enough cash and it fulfills all those three conditions, then you can go with buyback and you would have to pass a resolution for the same. Got this, guys? And this is how we compute. This is going to be very crucial. Question was there in November 2021 examination. It can come again in May 2022 examination. Note down this. ये काम आएगा. This will be very useful. Okay, ಇದು ಕೆಲಸಕ್ಕೆ ಬರುತ್ತೆ ಕಂಡ್ರೆ. Note this down. PUC plus free reserves plus security premium minus 50% of debt divided by buyback price per share plus nominal value per share. Doing this will give you the answer. Fantastic. So that's with regard to buyback. There's another small cute little part of your buyback chapter, that is equity shares with differential rights. This is again another topic on which the questions will come. Easy to do, very easy to do questions, but 5 marks will come in the exam. One more very lightly taken part of the syllabus, which people can't even know where it came from. You get this? So the topic revolves around this topic, that usually one vote, one right. Equity shares get to vote, preference holders don't get to vote. See, this is for equity shareholders, preference holders don't get to vote. Remember this image of equity shareholders. One who's waiting for money from the distance. Preference holder is the one who runs for money before equity holders and then collects it. Why? We're going to come back to this in our liquidation chapter. Okay. So preference holders can vote only if it affects their rights, or it is a resolution for winding up, or it is for reduction of share capital. Otherwise, preference holders cannot vote. Now, if it is in the case of I would say affecting their rights, then if they vote, how can they vote? What is the proportionate share of holding? That is what is questioned in this point. And otherwise, preferential right means higher or superior dividend or lower or superior voting rights. Yeah, so that's how, and this is given to a specific class of people. This specific class of people are either promoters or employees. Who are the people who get these preferential shares with differential rights? It's going to be either employees or promoters. One with the light is a promoter, and people standing here are the employees. So they get these differential rights, meaning with one share they can vote multiple votes. They have one share, but they can vote 3 votes. I have one share, but I can only vote once. That is to ensure that they take the risk and the right decision in the best interest of the company's taken. However, questions in the examination from these differential rights will come about like this. They will tell certain number of shares held by each of the party, equity and preference, and they'll tell what is the percentage of voting rights. I'll show you the question. This is the kind of question that you guys should prepare for. You just need to take the total of equity capital, preferential capital, whatever is given, and then total me will just find the percentage. Trying to figure out. Yes, this is the one. This is the one. This is November 18 exam question. It had come in the exam after that also. I think in May 2021 also there was a question on this. So there's no reason why you should be skipping this very important topic. Solve this question from November 18. It's a 5 marker, very easy. So equity share capital LMNO 30 40 20 10. BCD have preference share capital in 40 30 20 40 30 10 20. So total capital of the company, share capital is 60, equity and preference is 30. So what you do, equity share capital of 60, share it between LMNO 30 40 20 10 ratio, and then share preference share capital of 30 between B, C and D in 40 30 10 20. Take the total of the share capital, and then the money that they have, find the proportion. For that proportion, find out the ratio. That will be the percentage of holding that each of the shareholder will have if the resolution to be passed is for winding up, because preference shareholders also get to vote and they are on par with equity shares when it comes to voting for the sake of resolution, or to say dissolution or winding up. So that, my friends, is with regard to the topic of buyback and differential rights. We have successfully completed it, and in the regular class we usually discuss a lot of things with regard to wonder time. Like we'll discuss which company recently went for the buyback, is there buyback of preference share possible, is there buyback of debentures possible, what happens in the stock market right after the buyback, how will the market get affected, can the shareholders refuse buyback, all of this. We also show some buyback offers which I've got by mail from companies in which I hold shares and all. So that's what we do in the regular class. We will not be able to do it in the marathon revision that we're doing the day before exam. So this is the end of video number 1 in 4 videos for marathon revision of CA Intermediate Advanced Accounting. I am your CA Rajavardhan. Link to my profile on Unacademy is available in the description to this video. Please go down there and then follow me on Unacademy, and also like, follow and subscribe this YouTube channel for more such videos on CA Intermediate, CA Foundation and much more. And we'll take a break here. In the next video, I'll be starting with amalgamation and internal reconstruction of the companies. Got it, guys? Hello, fantastic. Remember, life is not a battle to be struggling, it's a game to be enjoyed. Till the time you're learning something, you're having fun, it's all good. The day you guys either stop learning something or stop having fun, trust me, you might start struggling because you might be in a battle. So, thumb rule to stay happy is pretty simple. It is to stay in the game. Hoping that you're all in the game. I have one small question to all of you. Are we in the game? I hope that you guys answered this loud that you are in the game. So this is the end of our second topic. Bye back. In the next video, we'll be discussing amalgamation and internal reconstruction and hopefully liquidation. Let's see. So maybe if we can finish these two in the second one. The third one we'll do liquidation and banking. And in the fourth one we'll do NBFC consolidation along with partnership or something of that sort. Yeah, that's it guys. Take a break. See you all in the next one.